This is Brian, the rockstar lender. He covers all of Southern California, really all California as a whole. But we're going to dive into what's going on in the market, what's happening with mortgage rates, what you guys can expect, how you guys can best position yourself to accomplish your goals during this shifting market, and then come out the other side ahead. So, Brian, thanks for joining me, man. Stoked to
Absolutely,
have
man.
you.
Thanks for having me.
Yeah, dude. So let's just kick it off. Kind of just your overall thoughts on what we're doing in the mortgage market, how the mortgage market is, and what people can kind of expect.
It's not all bad though. It's not all doom and gloom. Like there's always bright spots in situations like this. And here in Southern California, even though like you hear about mass exodus and people leaving, like houses, like yeah, it's not like it was 6 months ago when you threw a house on the market and there was like 10 offers within an hour. But like they're still being sold. Like they're not sitting on the market that long. You know what I mean?
Yeah.
There's still a demand for housing around here and prices are still going up. So like it's a situation where like it's it's still a good time to buy as far as real estate is concerned. And we don't have to worry about the situation like we did back in the late 2000s where the bubble burst and like literally like everyone lost everything, because that was based on like bad loans, subprime loans and everything. And lenders have been qualifying these guys realistically this whole time. Like,
Right.
none of these loans are, yeah, things happen sometimes. You gotta like change the circumstances with people and things happen, but they were qualified legitimately.
Yeah.
They can afford the house that they bought, and that they can afford to repay those loans. So, I mean, really what it comes down to is like, should you wait or not, right? Like, and I come across a lot of people that want to wait, and if you have to wait because you can't afford it, that's a different story. But if you have the money to put down and you can't afford the payment, you should, because you know like if you want to wait a year, that house might be $70,000 more,
Totally.
and you could have been paying down, so you lost the amortization gain too. So your net loss is actually quite significant. I mean, you could have net 100 grand basically by buying now.
Totally. Like
I
get in
mean,
now, seniority's
yeah, like
everything.
you're not going to get that kind of return in the stock market.
No,
I
100%.
mean,
Dude, and it's crazy here in San Diego. Actually, I saw this yesterday. And I had a couple investors that were throwing offers out there to see if they stick, kind of deal. But what we're noticing is the San Diego housing market, the Southern California, mainly coastal sections, they're not going down.
right.
Like there's parts of like
Absolutely.
Arizona, flyover states, like they're getting hit a little bit, but everybody wants to be by the beach. And it's like
Yeah.
people are like, oh no, I'm not going to buy it. It's going to crash. And just like you said with the subprime, like you have to have way more than a pulse to get a loan these days. It's like actually pretty difficult. So like there's a lot of things that go into it, which will then help us not have a repeat of
Oh
2008.
yeah. I mean, the procedures and policies they put in place after that is insane. I mean, like they put a lot of things in there, to stop people from doing that. And a lot of people that did the subprime lending, they got in trouble or whatever. And but you can't do that anymore, you
Right.
know.
No, you gotta do a little
You
bit
can't.
better job
And
now.
and to go back to one of the things that I know you like to say is, you marry the house and you date the rate,
Yeah.
you know, like, I mean, it's just that simple. If you can't afford it, like you can position yourself better down the road to lower that payment, refinance, whatever you want to do. But if you can't afford it, like it's a good time to buy.
100% less competition. I mean, I also read a
Yeah,
stat that actually 1 in 4 homes is owned by a company of some sort.
I know they're buying everything up, these hedge
Dude.
funds and
And
everything.
then Zillow and Open Door I mean, Open Door has its own issues now with the whole FTC
Mhm.
claim, but
Yeah.
Zillow and Open Door just comboed up, trying to, make it easier. But you guys, if you're selling your house to an iBuyer, you need to communicate with a real estate professional, a professional lender, communicate with someone other than the big companies, because they're going to show you that these fees, these hidden fees, it's going to be more like a 13% versus like a general, 6%, across the board.
Well, the thing about it is like your fiduciary responsibility is to the client. If they're just dealing directly with them, like their fiduciary responsibility is to themselves.
Oh, great point.
You know,
Super great point. Yeah.
I mean, we genuinely like want that. We want them to. We want our clients to tell their mom and their dad and their friends and their friends and friends and friends. So we're gonna and not to mention we literally our fiduciary responsibility is to them.
Yeah.
We have to find what's best for them.
We got to get them a smoking deal no matter what it is,
Yeah.
whatever
So
side. Yeah.
when you sidestep the person that's looking out for you, like
It's an issue.
yeah.
So as far as like this shifting market, I know there's a lot of uncertainty. What are some of the ways people can like best position themselves, or like the best loans that they can kind of look out for in
Sure.
this kind of shifting market, and why?
Yeah. And we've talked before, like there's no like silver bullet, right? Like because loans are, they're personal and situational to each family or individual. But we are seeing loans like the 2-1 buy down, and I'll explain a little bit about that here in a minute. That's coming back to the table, and it's, that can be really good, especially for like first time buyers and stuff. But essentially what it is, your interest, like you basically escrow money, and the money can come from like the real estate agent, like negotiating with the buyer. Maybe you like bump the price up a little bit and give like more concession, right?
Yeah.
To come back. And so you essentially escrow money so that the payments are based on, so for the first year it's 2% less. So like if you're buying a house at 6% interest rate, the first year your payments are based on 4% interest rate, and the second year 5%, the third year 6%. So it gives you like quite a bit of time. Like so you can pay the 6%, right? But like you don't have to. And it's a good way to like, within 3 years you can refinance.
Right. You kind of ease into it versus
Yeah,
just
ease
getting
into it.
slammed.
You don't get as much payment shock,
Right.
like from the beginning. So we're definitely seeing that come out more, and we're even seeing some like listings now that are like actually throwing that into the listings, like that, the 2-1 buy down is an option.
I have
Um,
seen that.
yeah, and so that's what that is. And then, you're seeing a lot more interest only loans right now, which, you're either 30 or 40-year terms. But the first 10 years are the payment is interest only. So of course you're not paying down any principal. You got to keep that in mind. But it still works in a market where houses are appreciating in value. You know what I mean?
True.
So like
Yep.
uh, as long as the home prices are going up, like you're still actually getting equity.
Yeah. Right. And then you just refi
um,
out.
Exactly. So, and the best thing about that is you like, so those typically have like a little bit higher interest rate, but since you're only paying interest the first 10 years, the payment's quite a bit less. It can be significantly less.
Got
And
it.
then you just, most people have the intention of course, refinancing
Yeah. And most people don't
within a
stay
few
in their
years.
house for 30 years. Like it's
I
so
mean,
rare.
most people I know do something like every 3 years,
Yeah.
man. I mean, whether it's take out cash and do something with it, or they start sell their house and move. Um, oh, there's my dog in the
Hey,
background.
puppy.
um, but yeah, so I mean, we're definitely seeing a lot more of those type of situations, just because with the interest only, they qualify based on the interest only payment, so you can qualify for that home a lot easier.
Cool. I like that. I mean, that sounds like a really good tool for these people to like
Yeah.
get into the home they want now before, because as soon as these prices quote unquote crash, if they do, you don't understand that all these investors that have millions and billions of dollars, all these big corporations, they're gonna come in like they did in that
Yep.
2.5%, 3% market that we were just in a few months ago. And you think that the buying was hard then, like it's going to get way more hard as soon as all those guys come back in and you're still trying to buy with these higher interest rates. So now, like Brian's telling you, now is the best time to get in, obviously, as long as you can afford it. But
Yeah.
with that being said, the affordability is one thing, but like what can we do to best kind of prep ourselves to qualify for a loan?
Right. And then, well, real quick, I wanted to throw in like that's one of the reasons it's so important to talk with like an actual like mortgage. You need a guy, you need a mortgage guy.
Brian's the guy,
Because
guys. Brian's the guy.
yeah, well, yeah. I mean, if it's not me, you need someone though, because
Right.
a lot of, there was a study, I wish I could remember it off the top of my head, but it was done very recently. And the average homeowner, like the average buyer saves about 8 grand in the long run using a broker.
Mm-hmm.
Um, and you'll hear like the big banks, Wells Fargo, Bank of America, all those guys will obviously they're not going to like cop to that kind of a thing. But I mean, it was a total independent study. I think it was like Home Point or one of the lenders that I know of did it, and they published the results. I should have got that information. But you talk to your broker, they're probably going to save you some money, but they're also going to know exactly like what you're looking to do with your life and your future plans and everything. So it makes a huge difference when like, when you guys are chit chatting about what kind of product to use for your mortgage. I mean, like I had there's a self-employed borrower, he's a business owner, and his tax returns, like most self-employed people, don't reflect that much income, but his bank statements, show a lot.
Right.
And so we did a 12-month bank statement loan. The interest rate's a little bit higher, but he's paying interest only, and he's expecting an inheritance in, roughly 9 months to a year, that he's just going to pay the $1 million loan off right then and there. Done deal.
Beautiful.
So like, it's just,
Creativity.
knowing what is going on makes an impact on what to choose. And you could be saving a lot of money just by explaining your situation to somebody.
100%. And people like, I find that people like when they come to me, for example, like I get a person just off the internet, like, hey, I saw a video you were doing. I want to buy a house. Great. Let's dive into that. I can tell that they're holding back information.
Yeah.
And I tell them, like, do not hold back. I'm not here to sell you. I'm here to serve you. And
Right.
the only way I can serve you is by you giving me everything that you need. Like you tell me
Yeah.
everything you need so I can best equipped. Like I need to go into my tool chest, obviously like you being one of my biggest tools. And then
Sure.
you have all your micro tools where I have my micro tools, and we come together to give this like fantastic solution to people. So you guys, if you're reaching out, whether it be us or anybody else, like make sure that you really jot down before you call or during your call, like tell them what you're looking for. These are my payments. This is my goal. This is how long I want to be here.
And just be
Even if you
honest.
don't know that stuff, just throw it out there because we have experience and we've done this hundreds of times to where we can help you kind of get to that end goal. Like the quickest way to bridge a gap is to find someone that's already done it and, just pay for the experience essentially. So
Sure.
just
Sure.
get there and get your result that you're looking for versus tumbling like a lot of us have, but now we have the experience to pass along to you.
Credit's a thing. Having a high FICO score definitely puts you in a better position. You're less of a risk, for the lenders, right? So I mean, obviously clean up your credit if you can. There's options for low FICO scores. There's good options too, but the better it is, the better of a deal you're going to get.
Mm-hmm.
And you want to lower your liabilities, which are the things that you have to pay monthly: your credit cards, your car payments, education loans, that kind of thing. So because all these things are a part of your debt to income ratio.
Right.
And so basically, like all your payments that go out monthly, you know what I mean, like is divided by what your stable monthly income is. And you want that to be the best case scenario for conventional loans. There's products everywhere, but we're going to stay with conventional because we would be here for a week if we tried to dive into each lender's different like niches and
Yeah.
whatnot. But so you want that to be under 36%. So like the more you can pay down, instead of having like, instead of having to pay $400 on your credit card, if you pay that off to where you don't have this $400 credit card bill every month. I mean, like that makes a huge difference on what
Yeah,
your
it
debt to
does.
income ratio is, like huge difference.
Huge.
So, I mean, I would just say, work on lowering those monthly liabilities,
Okay.
and cleaning up your credit, of course.
Yeah. And obviously by lowering those liabilities, your credit will probably go up.
Yeah, it will go.
So it's
And they're kind of
so
hand in
step
hand.
one,
Yeah,
get rid of the credit card debt.
right.
And if you
For
guys
sure.
are okay paying that 25% credit card debt, why aren't you okay paying a
I
3 or 4% on a house? Like it
Right.
doesn't make sense to me. I get it's a bigger number, but anyways, I digress.
That's a good
Um,
point,
real quick, we can touch on because a lot of people are hearing the adjustable rate mortgage, the
though.
ARM,
Right.
and they're like, oh, that's what got us in trouble last time. But maybe you can touch on kind of the pros, cons, and why it's not the same.
It is not the same. that was a big thing. That so part of it was, like now there's no prepayment penalties or that kind of thing. So you can get an adjustable rate mortgage now, and you can refinance out of it without penalties. It's not like before where you took a huge hit if you tried to get out of that arm.
Mm-hmm.
So now you can get into that arm and you can get out of it safely whenever you really want to. And the pros were, they generally come with a little bit of a lower interest rate. The thing about the arm is it's got a lower initial monthly payment, and that might be worth it for some people, right? Like, you know what I
Yeah.
mean? It's kind of like buying time, buys you time. Your property goes up in value and all these things. And so, when it come a year or two down the road, now you can refinance at a lower rate. So the way that the arms are set up is it's always like we'll say like a 5/1, it's just a 5/1. And so that one is the term is fixed for 5 years at what the initial fixed point, and then it will adjust every year after that, every 1 year. So that's what the one indicates, is
Got
the
it.
term. You know what I mean?
Yep.
And so there's other ones like a 5/6 arm where it's fixed for 5 years, and then it'll adjust every 6 months after that. But like, so for cons, like the biggest disadvantage, your rate is likely to go up. I mean, it's just that simple.
Right.
um, you know what I mean? Like, it's a good chance that the rate will go up.
Yeah.
Uh,
But
so
it's a tool. It's a tool to
it's a
use,
tool.
and it's like a planning thing.
Yeah.
Like you get in with this and leapfrog to this.
Yeah, it gets you to the next step. It gets you to the next step. Like, they're not bad anymore. Like, they're really not. There's, the other con, though, I will say this is, if some kind of life event happens and your credit suffers significantly, it
Mm.
will put you in not a great situation.
So planning is key, and you
Yeah, I
can't
mean,
plan for the unplanned, but you can
right,
do your
but
best.
if your credit takes significant, if it deteriorates, like you might be stuck in it. You know what I mean?
Yeah, totally.
So
Yeah,
that is definitely a con for
sure.
sure.
That's a big con, but
Right.
again, it's a tool. Like it's like a
It
knife
is.
knife in your kitchen. Like what do you use to cut the tomato versus the bread?
Yeah. I mean,
Um,
we're seeing a lot more arms. We are.
yeah,
But
definitely.
yeah, I know it's like a bad word to a lot of people because of what happened, back in
That
10 years ago
sucks.
or so, 15 years ago.
I guess the last thing I'd like to touch on is kind of purchasing power and what it looks like now versus what it looked like, before, and how much has the interest rate, or how much does an interest rate kind of affect your payment on, like,
Sure.
I don't know, 850 home or whatever.
Yeah, yeah. So preparing for the 850. So we'll just use an example. Like, that's kind of the best way to do this one. When we'll have to make some assumptions, being 20% down. So if you're going to put 20% down on a $850,000 home, you have $170,000 down, meaning you're borrowing $680,000. So let's say it's a 5% interest rate. So principal, interest, taxes, and insurance, that entire payment, your monthly payment for all that stuff combined is somewhere in the ballpark of like 4,500. Like, it varies, your insurance could be a little, so we're not going to split hairs here. We're just going to
Yeah.
say it's right around $4,500 a month. So basically, like, right, when you add your liabilities and everything on top of that $4,500 a month, and then you divide that by your monthly income, you get your a debt to income ratio. And so you want that to be under 36%. Now, let's say at 6%, you have the same exact situation at 6%. Now that PITI payment is now 5,000 a month. So it's gone up by $500. Now, when you add those liabilities on top of that makes a huge impact. A huge impact. 1% could make you so far over the needle, you're not even close to qualifying versus you did qualify.
Yeah, totally. That's huge.
So yeah, I mean, rate does matter. Rate does matter. And so, like, that's why there's ways of, doing interest only. Like, it brings us back to some of these things. Like, if you can get into a house, it could be a good time. You can get it in interest only. You know what I mean? Like, do stuff like that. Like, there's ways to make this work.
And
There's safe ways
have
to
a
make this
plan.
work. Yeah,
Yeah,
and have a plan. And
perfect.
then you're building equity. You're paying down that loan.
I always
American
I
dream,
always
right?
feel like I could see it and I can hear it. Like you're passionate about it, and I am too.
Yeah.
And it's like when you deliver this passion to people, you're like, you guys need to like stop reading the tabloids. Like stop.
Yeah.
Like it's killing people.
It
And
is.
like one of my investors, like, hey, like I don't think we're gonna see the bloodshed in San Diego. Like I don't think we're gonna see it. like all the, the news articles are like, oh, it's going to go down 20, 30%. Like we're so far away from a crash.
I
Like we're
know.
so far away. And it's like
But
I
the,
just feel
the
like
news
people,
isn't real news anymore. They have agendas and they make money off of you if you
yeah.
click on their stuff. It's not genuine journalism
But
anymore.
here's what here you for everybody like with really big uncertainty, here's the best way to combat it. If you're scared or nervous about buying a home right now, obviously you need to afford the monthly payment. Like that, number one. But number two is if you look at the facts and the figures, that uncertainty is going to go away. So if you have a
Mhm.
plan like this is what my payment is now, and this is what it could be, and this is how worse it could get, X, Y, or Z, you put your plan together, that will kill all uncertainty. So
For
look at
sure.
the facts, look at the figures, have like Brian can do it like a whole amortization schedule. And you can see exactly what it's going to be like in the future, now
Yeah,
and in the future. So it's like now is the best time to buy. We're not selling, we're serving. And the only way to serve is by you reaching out to us so we can help you build your plan of
that's
action,
right.
plan of, of execution. So for anybody looking to get qualified or pre-qualified for a loan, we're going to put a link down in the description. It's going to give you access to Brian and myself in our exclusive program that will allow you to essentially get a pre-qualification without talking to us, and then Brian will reach out to you and get more details to give you what's called
Yeah.
an approval letter. And that's what we really need to go shopping. But it'll give you a good baseline, and then that'll get you in touch with me a little more discreetly if you don't feel like reaching out. But Brian, for you, how can people reach out to you directly? What's the best way?
Yeah, my cell phone number, which is down there, 775-443-0553. Text, you can give me a call, text, whatever. My email will be down there, bmuller@c2financialcorp.com. Um, and yeah, like it's huge. And it's also good to have a situation like this where the broker and the realtor are in communication and everything like that. Like everyone being on the same page is good. And I'd even talk to your CPAs or, you know what I mean, like your financial planners, like all these things can help, set up really solid plans to build your wealth.
100%. And what about on social? How do they get you on social?
Yeah, so just look me up, Brian Muller with C2 Financial Corp. Still kind of new in the social media world with this, but B Muller Loans on Instagram. But yeah, so I'm pushing to get better at that.
All right, guys, drop him a DM, make him get on Instagram because that's
There
the
we go.
future.
There we go. Yeah,
But all right, man. Well, hey, thanks for joining in, and looking forward to doing another one soon.
absolutely. Thanks, man.
Thanks.